Hello, good afternoon, good evening, everyone. Welcome to Reversal Mastery, Fibonacci and Candlestick Tactics. My name is Ali Mortazavi, and as the head of training and education, I'm excited to guide you through the dynamic for the forex trading. Today, we will explore advanced techniques to decode market trends and harness the power of reversal patterns. Whether you are a novice trader or seasoned in the financial markets, this webinar is designed to enrich your analytical skills and a strategic approach to trading. So let's begin this journey to mastery together. But before we proceed, please give me some confirmation if you can see my presentation and you can hear my voice clearly. Then I would be more comfortable to continue the webinar after making sure that everyone can see the presentation very well. So I really appreciate if you send me confirmation through the chat box that you have. Then we will continue. Very well. Okay. Good. Okay, please note that this webinar is brought to you by Errante Broker. As you know, Errante is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. Before we proceed, it's important to take a moment to address our general disclaimer. Please be aware that all of the content that we are providing in this webinar is only for educational purposes, and it's not any kind of trading advice or investment advice, because you know that you should take into account that your investment objectives and level of experience before trading is a crucial point. So please remember that the historical or past performance of a trading system or market is not necessarily indicative of future results. And we are just going to educate you through providing you all the tools that you need to become a better trader, because CFDs are very risky products. Okay, now everything is set. Let's talk about the outcomes of the webinar. By the end of our session together, we will have gained valued insights and practical skills across several key areas. Firstly, we will explore market tops and bottoms. You will learn how to spot these critical turning points in market trends using candlestick charts, and this knowledge is pivotal for understanding market movements and preparing for potential reversals. And next, we will delve into applying Fibonacci extensions effectively. And this isn't just about knowing what Fibonacci extensions are, but mastering how to apply them in forex trading. You will learn to set strategic profit targets and manage risk, enabling more calculated and informed trading decisions. Our third outcome is to understand the phases of market reversal. You will comprehend the three crucial phases of market reversals to master the timing of your trades. Timing can be the difference between profit and loss in financial markets, and we are here to hone that skill. We will also cover precise entry and exit points using the Fibonacci extensions, and this section will empower you to combine candlestick patterns with Fibonacci levels to pinpoint precise entry and exit points, and this approach can significantly enhance the accuracy of your trades. Lastly, the interactive Q&A. As always, this is where you can engage directly with the material, ask questions, and get clarification on complex concepts. And we want you to leave this webinar not just with information, but with the ability to apply these principles in various trading scenarios effectively, as you will learn. And we're committed to not only educating you, but also equipping you with the tools to apply this knowledge practically. So let's get started, guys. Okay, now here we are. In this section, we focus on the mechanics of identifying precise tops and bottoms in market trends, a crucial skill in the art of trading. Firstly, let's define a zigzag pattern. It is a series of price movements that are characterized by sharp rises and falls, creating a zigzag-like appearance of the charts. Because we both know that price usually doesn't move in a straight line. We usually see a zigzag patterns on the chart, and these fluctuations are indicative of the constant battle between buying and selling forces in the market, and often result in the formation of tops and bottoms. What the, During my experience in forex, in educating or trading, one of the most crucial, let's say, questions that mostly traders have is, what is market top exactly? How can we identify the market top? Because when you look at the chart, you see each different trader can have a different opinion uh, about the tops and bottoms in the market. But here I'm going to give you a roadmap that would save a day for you to identify the tops and bottoms in the market. A market top is defined as a peak point where the price reaches its highest level before reversing downwards, and it's a signal that the buying pressure is exhausted and the sellers are starting to take control. We call it market top. It can happen at the end of a market trend. It can happen usually at the end of a market swing after an upward swing. So conversely, a market bottom is the lowest point reached by the price before it begins to climb again, indicating a shift from a seller's to a buyer's market, or from a bearish to a bullish market. Now let's examine the formations of market tops. This is a crucial part. The first formation, as you see here, shows a single candle with a high peak followed by a lower high, suggesting a potential reversal. Okay, I mean reversal in the market movement, not in a trend, because now if you have been following our webinar series, you know we explained the definition of market trend, which means a direction of consecutive tops and bottoms. But here we are going to explain the ways that we can spot those tops and bottoms to identify a right direction of the market. If I want to somehow explain it in a better way to illustrate it on this chart, let me just open my MetaTrader and then let's see what we mean when we are talking about market tops and bottoms. For example, here you can see on my MT4, this is a chart of gold on 1 minute, okay? And by tops of and bottoms, we mean these. We mean the levels that can lead us to identifying the market direction. Okay, here you see we have some major points that at the end of an upward movement, we see a market just falls through a new trough somehow, or a new, let's say, bottom, and we are going to define these market tops and market bottoms as you see here, because you're going to incorporate these definitions into our trading strategy today, and you will see how it makes everything much easier and how we can get a very, very effective trading strategy. So as you see here, this is the first formation that we explained. And the second formation depicts a more extended top with two high peaks at almost a similar level, indicating, yeah, strong resistance somehow. So in the third formation, we see three peaks with the middle one being the highest, forming a classic somehow, let's say, followed by a one with a lower high, and then we see this bearish candle. So when you are going to identify a market top, it doesn't matter if uh, you see a candle with a lower bottom, okay, or lower low. But the thing that we are looking for is a candlestick with the highest high among a group of five candles, two preceded candles and two following candles. This is the what we are looking for. So it can get a shape like this, standing as a highest high very clearly, or sometimes you see it comes with a double top somehow, or let's say a matching top with two candles, or sometimes you see it's not a bullish candle as you might expect. It's the bearish candle, and uh, it's not followed by the bearish candle. Sometimes we have a bullish candle afterward, but it comes in lower top. And also you might see a range of candlesticks, which is, you can understand that none of these candles has the let's say the lowest low. So it could be a bit difficult to understand, to identify the market top here. But the key is that firstly, we are looking for a candlestick. It's the highest high among a group of five candles. So in that case, we can easily identify the uh, market top among these five candlesticks. And then the fifth formation illustrates an initial high peak followed by a lower high. Again, we don't care if this is a bullish candle or bearish, but the only thing in which matters to us is the high. We see the lower high than the previous one. And a significant bearish reversal candle afterwards strongly suggesting a top or swing top here. And the last formation displays a high peak followed by this small, let's say, bullish candlestick, followed by this strong bearish candlestick, which you see closes below the last bottom of the market. So in that case, we don't need to wait for two candlesticks afterwards. We don't need this, let's say, market top be followed by two candlesticks. So as soon as we see a candle, the next candle closes below the previous or the last market bottom, it means we have identified the market top at this fourth candlestick among this group of five candles. So we have this formation for sure, also for let's say the market bottoms. As you see here, the first bottom formation shows a single candle with a deep trough followed by a higher low, hinting at a potential uptrend. And the second formation presents two low trough as a similar level, suggesting a strong support level. And then the third formation reversals, we see the middle trough being the lowest anyhow. And the fourth formation illustrates a variation with multiple low troughs indicating a potential accumulation phase before a likely uptrend. And what we care is the middle candlestick, which has the lowest low among a group of 5 candles. And the fifth formation is marked by an initial dip trough followed by a higher low and a significant bullish reversal candle, strongly indicating a market bottom. And here again, finally, the sixth formation shows a dip trough followed by a large bullish reversal candle, and see the last candle, or let's say the next candle after the market bottom, closes above the market's top. So in this scenario, we don't need to wait for 2 candles in aftermath of identifying our market bottom. So it can be very helpful when it comes to understanding the tops and bottoms. Turning our attention to this chart, we have a real-world example that illustrates the practical application of identifying tops and bottoms within a market trend. As we can see, each top is announced at a peak where the price action has reached a local maximum. You see, all of these market tops. These tops are critical junctures where sellers overpower the buyers, and they're leading to a potential trend reversal or pullback. Yep. Okay, conversely, each bottom is marked as at a trough, the point where the downward price movement holds and begins to let's somehow ascend. And these are the points where buying pressure overcomes selling pressure, indicating a possible reversals to an uptrend, or at least a significant retracement during this downtrend. So you see, we have market tops and bottoms during zigzag patterns, but we see the overall direction of the market is downing. So it means we have a constantly lower top. Each top comes lower than the previous one, and each bottom comes lower than the previous bottom. So it means if we want to identify a general direction of the market, we would say it's a downtrend, but during this downtrend, we can let's say somehow spot the short-term support and resistance levels using the formation of market tops and market bottoms to understand where we have an intense level of buying pressure, like here, these bottoms, or selling pressure here that forms market tops. So throughout the chart, we observe these points of reversal at varying intervals, okay, highlighting the fractal nature of market movements. Identifying these points requires a keen eye on price action and candlestick formations, which signal shifts in market sentiment and momentum. So if, for example, you're looking for a good entry point to, let's say, enter this trend, you can wait for breaking of each market bottom as a support level, or you can wait for the market to form a new top. So you can open a sell position at the higher price that would be, and you can expect more profit as long as the trend is intact to the downside. So for instance, we see several distinct tops that are formed after a noticeable upward movement and characterized by either a single candle with a long wick or a small group of candles, as we explained in the six forms of our, let's say, illustration for market tops and bottoms, where the final candle's high is not exceeded by subsequent price action. Okay, and similarly, the bottoms are identified by a single candle with a long lower wick or a group of candles where the final candle's low stands unbreached by following price movements. So this chart exemplifies how traders can use these identification in real time to make informed decisions about entry and exit points. Don't forget, guys, we usually, if you want, let's say, to develop a trend following a strategy, you always need to identify the prior trend, the existing trend, and then you need to go in the direction of the general market trend. For example, when you identify the market somehow downtrend, you always looking for a sell position, okay, or opening a short position, and vice versa. When you have an uptrend and you want to trade in favor of the general market direction, so you need to look for, let's say, buying opportunity, or you want to open a buy position. So this is the way that usually traders can use these identifiers in real time to make informed decisions about entry and exit points. By recognizing these tops and bottoms as they develop, traders can better anticipate market turns and enhance their trading strategy. And here, we have taken the identification of tops and bottoms a step further by connecting these points. We connect each top to the, let's say, following bottom to illustrate the market zigzag pattern. And this visualization is instrumental in understanding the market's fluctuating nature and provides a clearer view of the trend's trajectory. So starting from the left, we can see how each top is followed by, let's say, a subsequent bottom, creating a series of peaks and troughs that map the market's ebb and flows. See, this top, this bottom, here we have almost the same top, and the bottom, it shows a market range, if you remember our previous webinar. Yep. And then we see the lower top than the previous, and the lower bottom than the previous, and again the lower top than the previous one. So it fits the definition of a downtrend, and then you see afterward we have the price falling down. So these zigzag lines encapsulate the market's volatility and depicting how price action oscillates within a trend. Notice how the line connecting the tops and bottoms creates angular patterns, embodying the shifts in market sentiment. Each upward line toward the top signifies increasing buying pressure, while each downward line towards the bottom indicates increasing selling pressure. And so it's very natural to see that the selling pressure usually lasts more and usually extends more than the upward pressure or buying pressure, because again we are in a downtrend. So this is the way that by comparing the also the length of each swing, the downward swing and the upward swing, you can compare the power of buyers and sellers in the market, and this is a way to engage trend momentum or somehow the strength of the market sentiment in overall. Okay, so this zigzag pattern is not random. It reflects the collective response of market participants to external stimuli, economic events, and technical levels, whatever that we don't know, that moves the market in this downtrend. This is what the swings that's let's say opportunities for entry and exit present themselves. Traders who can interpret these patterns effectively can exploit the market's rhythm to their advantage, identifying potential reversal points, which is our next step before the trend becomes evident to the broader market. But by examining the slope of these lines, their length, and the depth of the peaks and troughs, we can infer the trend's strength, as I explained. So, for instance, shallower bottoms and steeper tops might suggest a bullish trend gaining momentum, while the opposite would indicate a weakening uptrend or a potential bearish reversal. So understanding the nature of these exact patterns is critical for strategic trade placement and risk management, as they help in forecasting potential price targets and stop loss levels. And you will see how. But as we continue our exploration into the realm of market reversals, it's crucial to grasp the three cardinal rules that govern reversal patterns. Guys, do you remember these rules that we explained in our previous webinar? Let us just have a recap on that. Okay, let's start with the rule number 1. This rule emphasizes the existence of previous trend. A reversal pattern is credible only when it develops within the context of a pre-existing trend. So it is this trend that sets the stage for a potential shift in market dynamics. Bearish reversal patterns, for example, materialize at the conclusion of an uptrend, signaling an impending downturn. Conversely, bullish reversal patterns emerge at the terminus of a downtrend and heralding a possible upswing. Because, guys, keep in mind that without the existence of current strong and very obvious market trend, it's really nonsense to think about the market reversals. Yep. So this is the first step. First, we need the existence of previous trends. And the rule number 2 is that this rule actually deals with reducing momentum in the realm of bullish patterns. When sellers are unable to force new lows, it's often, let's say, portends a nearing trend reversal. Similarly, within bearish pattern, if buyers are incapable of crafting new highs, it signals that a change in trend could be on the horizon. So this waning momentum can often be precursory to a shift in market control from one group to another. And rule 3 is about breaking down key levels or beyond key levels. It's not enough for the price to merely approach these levels, only the 1 and 2. A bona fide bullish reversal is confirmed only when prices penetrate the key resistance level. On the flip side, a bearish reversal gains verification only by decisively breaching a pivotal support level. So these breakouts or breakdowns are the definitive signs that the balance of market power has shifted, cementing the reversal's authenticity. Okay, so by integrating these rules, we understand that the precise identification of tops and bottoms is not just a matter of charting, but a fundamental technique to somehow discern the ongoing trends. When tops or bottoms fail to reach new highs or depth, we stand alert for a reversal. However, true confirmation comes only with the price's ability to break through significant levels, resistance in the case of bullish reversals, and support for a bearish turn. So these principles provide a robust framework for traders to anticipate and acts upon potential reversals, enhancing the strategic depth of their market analysis. Now let's apply the three fundamental rules that we explained to of this the concept of trend reversals to four bearish chart patterns, each illustrating the shift from bullish to bearish sentiment. First, we have a double top pattern. This formation is characterized by two distinct peaks at approximately the same price level, indicating a strong resistance. The pattern is completed and confirmed as a bearish reversal when the price falls below the support level it had formed between the two tops. This is a rule of thumb, okay? And next is the head and shoulders pattern. I'm pretty sure that if you are a trader, you are familiar with this pattern. You know, this pattern is often considered one of the most reliable bearish reversal patterns. So it consists of a higher peak as a head, flanked by two lower peaks, the shoulders, one at the left and one at the right. The reversal is confirmed when the price action breaks below the neckline, which is the most critical components of the pattern, the support level connecting the lowest points after the first and second peaks, or let's say the first and second shoulders. So the third pattern is known as bearish failure or non-failure swings, and these swings depict scenarios where an attempt to reach a new high fails, followed by price drop below previous bottom, indicating a reversal. In non-failure swing, let's say even though a new high is made, subsequent price action breaks below the support level, signaling a bearish reversal. And lastly, we examine the triple top, similar to the double top, but with an extra peak. This pattern shows three attempts to break through a resistance level, as you see here, and each failure to push higher followed by a decline below support levels and underscores the weakening bullish momentum and the potential for a bearish reversal. But guys, please focus here. For each of these patterns, the rules of trend reversals are evident. First, the existence of a prior uptrend, a reduction in momentum indicated by the failure of to create new highs, and the decisive breaking of key support levels. So these bearish formations are pivotal for traders as they often precede significant downward movements, providing an opportunity to exit long positions or consider short entries. Okay, we have the similar for the, let's say, famous bullish chart patterns here, as this slide presents an illustration of the most famous bullish reversal chart patterns. First, we have the double bottom pattern, then the reverse head and shoulders, and also bullish failure and non-failure swings. Let me just wrap it up a bit faster because we explained the formation and the shape and the price for rejection afterwards for each of these patterns in very great detail in our previous webinar. So let me just address you to watch our previous webinar on the website to get a full picture of how these chart patterns work. But the thing is that each pattern adheres to the reversal rule. Again, the existence of a downtrend, a decline in bearish momentum indicated by the inability to form new lows, and a breakthrough of key resistance levels. So these bullish formations are critical for traders as they often precede a substantial upward price movements, providing opportunities to initiate long positions or to exit short trades. Okay, moving forward in our comprehensive exploration of trading reversals, now we turn our attention to Fibonacci extensions that I saw we had a couple of questions about that earlier in this webinar. This is a sophisticated tool for identifying entry points and managing trades during market reversals. Okay, what exactly are Fibonacci extensions? These are a series of ratios derived from the Fibonacci sequence and a notorious series of numbers where each subsequent number is the sum of the previous two. Okay, but what we are more interested in is the ratios. These ratios including 61.8%, 100%, 161.8%, 261.8%, and sometimes higher levels like 300, which is not a Fibonacci level, but traders usually consider it as an important key level, and also the 423.6%, which is derived from the Fibonacci sequence. These are used in technical analysis to predict potential support and resistance levels. And these levels are not only mathematical curiosities, they are often observed as points where the markets may pause or reverse. So the levels measured by Fibonacci extensions serve as a map for traders charting possible destinations following a retracement. And after a price retracement, traders can project these extensions of the initial move to gauge where the price may extend to before finding resistance in an uptrend or let's say a support in a downtrend. Okay. On the chart to the right, you can see Fibonacci extension levels applied to price movements. Let me zoom in a bit. It will be more clear for you. Okay, so you see the 0 level represents the start of the initial move, and 100, which is here, okay? And 100% is the end of the move. So what does it mean? It means the 100 is the start of a retracement. But you see, after the retracement, we start a move in a direction of a general, sorry, in favor of the general market direction. So we consider it as a level 0, and then we consider as a start of the initial move, and then 100% is the end of the move, and the subsequent levels indicate where the price could extend to following the retracement. So these extensions, as you see here, we have 127, 161, 200, 261. Okay, these extensions help traders forecast how far the price could go, enabling them to set a strategic profit targets and manage risk more effectively. So understanding and applying Fibonacci extensions requires practice. Okay, it requires practice, guys, but they are an invaluable component in the trader's toolkit, offering a deeper insight into market dynamics and potential turning points. So let's see how it works. Let's delve into the strategic application of Fibonacci extensions in the context of bullish market reversals. When we observe a prior downtrend that begins to lose momentum, culminating into formation of a higher bottom, we stand vigilant, okay, for the price to breach the last top. Sorry, let me just turn on my laser point to show it better. Okay. To utilize Fibonacci extension effectively, we must adhere to a systematic approach, mapping the uptrend. Let's say we are at the end of a downtrend. So we see a signs of price reversal, and we want to spot at the beginning of a new trend in upside as an upside movement or a new uptrend. Okay, so first of all, we are going to map the uptrend. We begin by identifying the last significant top in the market, okay, and bottom within the trend, the prior trend, let's say. And the top in this case serves as a potential entry point, while the bottom represents a higher low, marking where stop loss could be sensibly placed. It's crucial to draw the Fibonacci retracement tool from left to right, guys, all the time. All the time. Doesn't matter if it's an extension, if it's a projection, if it's a retracement, doesn't matter. We draw the Fibonacci tool always from the left to the right, starting from the swing low. Sorry, here in this case, from the swing high to the swing low. Okay, so in the context of bullish reversals, the Fibonacci levels of 127.2, 161.8, 200%, and 261.8% are of particular interest. And so these ratios beyond the 100 mark represent extensions for the price movement and serve as markers where the upward trend may encounter resistance. So we can just spot the potential resistance levels if we see a new uptrend proceeds. So how we can trade it, as you see, a pivotal trigger for entry is identified by a candle closing above the 100% level, this candlestick here, okay, which is the end of the initial price move, the 100%. Yep, very good. So setting a stop loss order below the most recent swing low provides a risk management somewhere like this, and provide a risk management measure and somehow safeguarding against false breakouts and reversals. The step-by-step method of drawing these levels on the chart involves selecting the Fibonacci retracement tool in your trading software, then clicking at the swing top point, then drag the tool to the swing bottom point from the left to the right, ensuring it's aligned with the significant peaks and troughs in the prior trend. So then releasing the tool to display the Fibonacci levels on the chart. With the levels drawn, we can then interpret these as potential targets for taking profits or adjusting our stop loss orders accordingly. This systematic approach allows for precision in planning trades and managing risk, aligning with the core principles of technical analysis. Because it's going to be the beginning, the earliest stages of beginning a new uptrend. So this is the best place to find an entry point, because we can expect the let's say the highest momentum of the market or the strongest move at the beginning of a trend. This is the point. Let me just go through it. The point is that let's look back at the MT4. Okay, I hope you can see my MT4 right now. Yeah, excuse me, guys. Can you see my presentation? Would you please send a confirmation? Those who can see my presentation, I would appreciate that because I've gotten some let's say comments from some of our participants that they can't see the presentation. Please let me know if the issue is fixed. Okay, okay, very well. Okay, let me just bring up my MT4 to show you the application of Fibonacci. It might be a bit confusing for some people, but let's say we are going to make it very easy, guys. Okay, for example, here you see we have a downward movement after this lower tops and lower bottoms, and then we see the higher bottom than the previous one. So we are going to apply the Fibonacci extension here. For that case, you just need to click on the Fibonacci retracement. And the one thing is that from the last top to the last bottom, that's it, from the left to the right. But there is something, you may not have these levels here, 127.2, which is my favorite one, and also the 200 or 161.8. The only thing is that you need to right click on that, and then this window will pop up, and you will be able to add or somehow adjust all the levels you want here. You can delete each of which levels you see here, or you can just click on the default to see the default retracement levels. But if you want to add, you can just easily click at this add button here and then add something like this 1.272 and then click OK, and you it will be shown on your MetaTrader. Okay, so this is a way that you can apply Fibonacci extensions using the Fibonacci retracement tool on your chart. Very well. Great. Okay, no further question. Very well. So let's jump on the last slide that we have. Now we are going to leverage Fibonacci extensions during bearish market reversals. Firstly, when we spot a prior uptrend that starts to lose momentum indicated by the formation of a lower top and lower bottom. So we anticipate a potential bearish reversal. A break below the last bottom can confirm this reversal for us. So Fibonacci extensions are utilized to project potential support levels, which could act as profit targets once the reversal is underway. The Fibonacci is always drawn from left to right. Following these steps, identify the last significant bottom, which could serve as the potential entry point once the reversal is confirmed. Okay, so extend the Fibonacci tool to the last significant top, which is the lower top in a beginning of a new downtrend, and may act as a level for setting a stop loss. So then the Fibonacci levels of 127.2%, 161.8%, 200%, and even 261.8% are then interpreted as potential support levels, where the price might encounter some buying interest, potentially slowing or reversing the downtrend, as you see on my charts on the right. So for entry and exit points, a key trigger for entry is a candle closing below the 100% level, which indicates the end of the retracement here. Yep. The end of the retracement, you see closing below this critical support level and the potential start of a new downward move. So stop loss orders are set above the most recent swing high somewhere here to minimize losses if the price reverses direction. It's essential, guys, to seek additional confirmation all the time. A decisive candle close beyond a key Fibonacci level may act as a triggering candle, but we look for the next candle to confirm this move to avoid false breakouts. What we call it the bear's trap, and we explained it in our previous webinar. So this confirmation can be further substantiated by other technical tools, such as oscillators, which might show oversold or overbought conditions. And finally, it is really critical to understand the Fibonacci extensions as potential levels where price may react, but they are not definitive. So they do not act against the price all the time, but provide zones where traders should be somehow vigilant for price action signals or other indicators that confirm the level significance. Very well. So as we conclude this segment of our webinar, it's important to recap the key takeaways and contemplate the practical application of the concepts we've discussed. First, tops and bottoms are pivotal in understanding market trends and reversals. Second, reversal patterns adhere to three fundamental rules: existing trend, reducing momentum, and breaking key levels. Then Fibonacci extensions offer a precise tool for projecting potential support and resistance levels following a reversal. We draw Fibonacci from left to right all the time. That helps traders plan their entries and stop loss levels. The point number 5 is that confirmation of reversal signals is essential, often requiring more than one candle or additional technical indicators like RSI or moving averages. And the point number 6 was that Fibonacci extension levels are potential zones, but not guaranteed barriers, okay? Okay, we got to the end of today's webinar. Thank you for joining us today, and I look forward to our continued exploration of the fascinating world of trading. If you have any further questions or need assistance, please feel free to reach out. Wishing you success and profitable trading ads. Thank you so much. Have a great evening.